Welcome back to the Global Ledger. I'm Justin. Today, we're going to touch on one of the most misunderstood financial events that comes up in discussion quite often, and that is the March 2020 dollar crisis, COVID crisis, you could say. People think the crash was caused by lockdowns, pandemic fear, unemployment, or economic data. And that's not what happened. What actually happened was a global run, a scramble for dollars, a collapse in collateral chains, and a breakdown in Treasury market liquidity. This was one of the largest, fastest dash to cash in modern financial history. So it wasn't a recession-driven sell-off. It was a funding crisis, a systemic one. Let's get into it. By early March 2020, the world was frightened, but markets weren't crashing yet. Then something snapped. It wasn't the stock market, wasn't the corporate bond market, and it wasn't a panic in retail. It was the U.S. Treasury market, the deepest, most liquid financial market on earth. Suddenly, bid-ask spreads exploded. Treasuries sold off when stocks were crashing. Repo markets tightened. Dealers reached balance sheet limits. And foreign institutions dumped treasuries aggressively. Money market funding just wobbled. Treasuries are supposed to rise in a crisis, but they fell. Why is that? My best explanation on this is because treasuries aren't just risk-free assets. They are collateral, the foundation of global dollar borrowing. So when everyone wants dollars at once, they sell the best collateral they have, and that's U.S. Treasuries. So this was the moment the pandemic became a dollar crisis. COVID caused a lot of uncertainty and, a lot of damage, and it was just turmoil. Overall, uncertainty caused margin calls. Margin calls caused forced deleveraging, and deleveraging caused asset sales. Asset sales, well, they undermine collateral values, right? And so which continued to cause more margin calls and so on and so forth. So this is a classic liquidity spiral. But the key here is that the world ran for dollars, not gold, not crypto, not commodities, dollars. Foreign institutions, they were hit especially hard. The European banks were short dollars. Asian corporates had dollar liabilities. Emerging market borrowers needed dollars to service debts. Sovereign wealth funds liquidated treasuries to raise cash. FX swap bases clearly blew out. That's in the data. This is the global dollar shortage. The BIS and the IMF, ones in which have warned about such things for decades. So the world doesn't just want dollars, it owes dollars. In March 2020, those dollar liabilities came due all at once. So the real breakdown happened in the dealer system. Dealers are market makers in treasuries, and intermediaries of repo, the balance sheets that stabilize liquidity globally, everywhere. So, but in March 2020, they hit balance sheet constraints, regulatory limits, internal risk limits, clearly, and an explosion in volatility. So they couldn't warehouse more treasuries, couldn't intermediate flows, and couldn't expand their balance sheets to absorb global selling. And when dealers fail, the markets follow. This is why treasury liquidity collapsed. Not because of fear, but because there was a clog in the plumbing. During the panic, repo lenders demanded more collateral. Haircuts rose. Some collateral really became unacceptable. Dealers could not roll funding. Margin requirements even multiplied. This is the shadow banking equivalent of a bank run. Except instead of depositors pulling cash, repo lenders pulled funding. This is why Treasuries sold off, not because people didn't want them, but because institutions needed dollars now. And the only thing liquid enough to sell was the Treasury. So just like in 2008, money market funds saw massive outflows, rising redemptions, liquidity stress, reluctance to roll commercial paper. Commercial paper markets froze. Corporations suddenly couldn't borrow overnight. Short-term funding just seized up. This was a system-wide liquidity freeze, not in, equity panic. The Fed, in this case, responded with several things, and I'll list 5 or 6 of them. I'll start with number 1, which they responded with unlimited Treasury purchases. This was to unfreeze the Treasury market and restore the dealer balance sheets. Very important one. Number 2, they responded with unlimited repo operations. This gave markets all the collateralized funding they needed to continue. They also responded with dollar swap lines with major central banks. This was to stop the global FX swap funding squeezes that were happening. They also responded with money market backstops. And things like the MMLF and the CPFF, and all of this is publicly online on the Fed's website. And these money market backstops were to prevent a run on money funds too. So number 5, I would even say corporate credit facilities. They needed these to stop the collapse in short-term corporate borrowing. Number 6. QE, really with no upper bound either. This was to stabilize the system's top layer. The Fed didn't stimulate the economy. It rebooted the global dollar system in this case. So without their intervention, Treasury markets would have failed. Money markets would have broken. Repo would have just collapsed. And really the financial system would have just imploded. It's as simple as that. March 2020 was not about the stock market. It was about the solvency of the global dollar funding machine. Look at every major stress since 1998. LTCM, 2008, 2011 in Europe, 2014 to 2016, emerging market dollar squeezes, 2019, the repo blowout, so on and so forth. What do they have in common? They're all dollar funding crises. The world runs on dollars. Shadow banks run on repo. Repo runs on collateral. And collateral runs on treasury liquidity. When that chain breaks, everything breaks. In understanding this will removes fear. Most people think 2020 was a COVID market crash, but when you understand what actually happened, the collateral dynamics, the dealer balance sheet constraints, and the Fed's role as global supplier of dollar elasticity, the fear can disappear and clarity shows up. And this series is about giving you that clarity. So thanks for listening to episode 34 of the Global Ledger. Today, we walked through the real mechanics behind March 2020, which hopefully at this point, we see as a global dollar crisis masquerading as a pandemic crash. In episode 35, the next episode, we're going to look at inflationary crises. So when the lower layers of the hierarchy start to push back. So once again, I'm Justin, and thanks for being here.